Bitcoin bull or eagle. So I saw this and it was interesting, right? And it said that Bitcoin in the drawdowns, when it draws down like it draws down, it says that the drawdown is anywhere between 80 to 77%. And so in 2022, it dropped 77%. In 2018, it dropped 84%. And in 2015, it dropped 87%. That's the thing about the future, bro. You don't see it.
Yeah. Hindsight 2020. You probably would have spit some of that. You would have came off of that too when it went up.
No, because I had the investor mindset. So I just didn't, I'm not gonna be real with you. I just didn't believe it like that in 2015. I'm just being 100% real with you. Like I was like, what? Bro, crypto, man, get out of here, bro. Because I knew some people that use crypto for some other stuff that I ain't gonna say about and all that. Right? I just didn't believe in it like that. 2015, bro, I was selling t-shirts and I had just started this. I was hot into it. I was like, yeah, I believe. I had done told y'all, hey, this gonna change the game for us, dog. I just didn't believe in it, bro. But 2015, god damn. Hot 10 grand about. Damn, God. 2015, a hot 10 grand at 1,000 something. That thing at 126. Man, we multi-millionaire. Damn.
Multi before I die.
Should make 2015, I was fresh out the trap too. Damn. Hey, bro, you look at it like that. You like, God, hey. Anyway, here we go. So when I saw that, I was like, all right, that's interesting. So let's go a little further. Now, this is not my expertise field. I was just looking at the patterns, and I saw this, and I just want to see, is there legitimacy behind it? And I saw the chart pattern, I was like, damn. So it said, this was some ranges that it went in. 364 days, and then it had like 1,070 days. That was those patterns in each one of those. And I said to myself, damn, like, that's interesting in that pattern and in that phase adjustment, how that looks. And basically what it's saying is that it is on par. I'm not the crypto expert, but I pay attention to it because I own it. If you believe in it, I believe in it as far as it being the future. I believe at some point, you know, we all gonna be on a crypto standard at some point. But today is at 69,000 right now. Now go back one more. Think about this. At 69,400, it is now the same price it was in 2022. Come on, we'll put some context on it. It's just a little context. 100 to 2015, it was $152. Oh my God. Bro, $152, cuz? I had a hot 10 for it, cuz. So all I'm saying right now is, in 2025, it was $126,208. As of right now, it's 69,000. It was 69,000 in 2021. I'm not the person to tell you to buy it. I'm not the person to tell you stay away from it. I am the person to tell you that it has some massive swings to the downside. But think about this. Watch what I'm about to say here. From 2013 to 2015, it goes from $1,100 to $125. Now from 2015 to 2017, it goes from $152 to $19,000. This is erratic. Now watch this. From $19,000, it goes to $3,100 in 2018. But in 2022, it goes from $3,000 to $69,000. And then it goes from $69,000 in 2021 to $15,000 in 2022, only to be $126,000 in 2025. So that's telling you that, watch somebody say here, there's an opportunity somewhere. I don't know where.
It's in there.
But it's, take me through that, take me through that.
It's in there somewhere.
I'm just saying that there's an opportunity. Now, let me say this a little further. If these swings happen between 87 and 77, that means there's about a 30% more downside to go. Let me say this. History doesn't always repeat itself, but it does rhyme. So what if it doesn't go to 77? What if it hits 50%? Now, here's what the numbers say. The numbers say that in 2 to 3 years, this will easily be $250,000. That's what I'm saying. I'm not saying I'm predicting this. I'm saying based on the data from the swings that it's having at 68,000, let's say if we do 50%, that brings it down to maybe 60,000. It'll at least, let's see, from 100 to 3,000 is a huge return. And then from 3,000 to 15,000. So if it's at 68,000, 300,000 is not off the books in 3 years. Because we're talking 3-year increments right here.
It's just going to be some choppy waters, but yeah.
You got to be able to say, hold.
Ride the wave.
Turn the phone off. Close the laptop.
Right.
Look at it. Let me see what this is. 2026. By 2030. The problem is.
Just delete the app.
Watch this. I'm going to tell you
something.
something.
Your password, though.
The problem is the noise. Watch this. The problem is the noise gets so loud, it manipulates you to get out of position.
Yep. On both ends. But yeah.
The noise gets so loud. But all we got to do as investors, as traders, is say, what does history say? And no, this time it's not different. It don't ever get different. It's not different. It just finds a new reason to sell off. But history tells us in 3 years, this could easily be 300,000. Now, the problem is you're going to say, back 3 years is too long. Until you look back now, we like, bro, what was I doing in 2015 where I didn't put 10 grand at $152?
Yet, Bitcoin is dumping hard, down from $90,400 to $70,000 in days. This breaks every macro playbook. Historically, when the dollar weakens, Bitcoin should rally. So, what's actually going on? Today, we're breaking down the 5 forces destroying Bitcoin's traditional correlation with the dollar and revealing when this relationship might finally restore itself. My name is Lewis, and you're watching the Coin Bureau. Now, for years, Bitcoin and the DXY moved in opposite directions with a negative 0.65 correlation, a reliable inverse relationship. When the dollar strengthened to 114 in Q4 2022, during the Fed rate hikes, Bitcoin crashed from 47,000 to 16,000. When DXY fell in late 2023, Bitcoin rocketed past $40,000. The math was simple. Weak dollar equals strong Bitcoin. But since mid-2024, this relationship has fractured completely. The dollar is now down 1.5% in January 2026, breaking below 97 to hit levels not seen since February of 2022. Yet Bitcoin refuses to rally. In fact, it's doing the opposite, falling from above $90,000 to current levels around $70,000. Maybe lower by the time that you watch this video. And this isn't just a blip. The 90-day correlation coefficient, which historically sat at negative 0.70, has broken down entirely. Bitcoin is now moving with tech stocks, not against the dollar. The 30-day correlation between Bitcoin and the Nasdaq has hit 0.80, the highest level in nearly 4 years. So Bitcoin has gone from being digital gold to being a risk-on tech asset, and that creates a very different investment thesis. Now, here's the twist that most investors are missing. A weak dollar doesn't automatically mean more money in the system. Put simply, there's a massive difference between dollar weakness and actual liquidity expansion. The euro-dollar market, offshore dollar-denominated deposits, controls global liquidity beyond the Fed's reach. This market is estimated at $16 trillion, more than double what it was in 2008. When the DXY falls due to yen intervention or currency rebalancing rather than Fed easing, actual liquidity doesn't expand. It's a liquidity mirage. Michael Howell, founder of Cross-Border Capital, has been tracking this phenomenon with his Global Liquidity Index. According to Howell's data, global liquidity peaked in late 2025 at around $187 trillion. But here's the kicker. The momentum has stalled. Howell's model suggests the liquidity cycle is hitting its peak around Q1 to Q2 2026, likely in March. After that, he expects a downturn as the massive debt refinancing wall begins to drain capital. So even though the dollar is weak, liquidity conditions are tightening. This explains why Bitcoin isn't rallying. There's no actual new money flowing back into risk assets. The Fed ended quantitative tightening in December of 2025 and started buying $40 billion in treasury bills monthly. But this is just maintaining liquidity, not expanding it. Meanwhile, the euro-dollar system creates and destroys liquidity through bank balance sheet expansion and contraction, processes that are completely independent of the dollar's exchange rate. This is why dollar weakness alone isn't really enough. Markets are treating Bitcoin as a risk asset, not digital gold. And the evidence is overwhelming. When uncertainty spikes, trade wars, geopolitical tensions, Trump's tariff threats, investors flee to traditional safe havens. Gold ETFs saw record inflows in 2025, with $89 billion globally, the strongest year ever. Central banks added 863 tons of gold in 2025, with purchases remaining elevated at 220 tons in Q3 alone. China has been buying gold every single month while simultaneously selling U.S. treasuries. In fact, Chinese treasury holdings dropped to $682.6 billion in November of 2025, the lowest since September of 2008. Meanwhile, China's gold reserves increased to 2,306 tons, valued at over $310 billion. And Bitcoin, well, it's getting sold alongside tech stocks. During recent geopolitical flare-ups, Bitcoin lost 6.6%, while gold rose 8.6%. The BTC to gold ratio hit 17.6 in early 2026, recently touching as low as 15.5, the lowest in recent history. For comparison, gold gained 65% in 2025, while Bitcoin declined 6%. This completely inverts the digital gold narrative. And if you've been following the channel, well, you know that this creates a massive opportunity cost problem for Bitcoin holders. And by the way, if you're trying to navigate these complex macro crosscurrents, you need to stay informed beyond just the price charts. So why not subscribe to the Coin Bureau Telegram channel? There, we'll keep you posted with U.S. government debt maturing in 2026. It's about the largest debt refinancing event in modern history. You see, there's $9 to $10 trillion in U.S. government debt maturing in 2026, roughly 1/3 of all outstanding debt. This creates a massive refinancing wall that sucks capital from risk assets. Corporate debt maturities are spiking to roughly $3 trillion in 2026, up from $2 trillion in 2024. That's a 50% increase. Companies that borrowed at 2 to 3% in 2020 and 2021, well, they now face refinancing at up to 5 to 7%. For a company with $100 million in debt at 3%, annual interest is $3 million. Refinancing at 6% doubles the interest cost to $6 million, reducing earnings by $3 million annually without any operational changes. And this is already showing up in bankruptcy data. 2025 saw an 81% increase in mega bankruptcies compared to the long-term average. Saks Global filed for Chapter 11 in January 2026 after missing a $100 million debt payment. The company had borrowed $2.7 billion to fund its merger, debt it simply couldn't refinance. Meanwhile, commercial real estate is facing over $1.5 trillion in maturities through 2026 and 2027. Office sector CMBS loans totaling $21.3 billion are coming due through 2026. This means many borrowers now face refinancing rates double or even triple what they secured years ago. This isn't theoretical. This is happening right now. And every dollar that goes to refinancing existing debt is a dollar that doesn't flow into Bitcoin or other risk assets. Michael Howell warns that this $40 trillion global debt rollover by 2027 creates unprecedented refinancing stress. He calls it the most significant threat to markets in the 2026 to 2027 window. Meanwhile, Japan and China are reshaping global liquidity flows in ways that directly impact Bitcoin. The yen carry trade unwind, for example, where investors borrow cheap yen to buy riskier assets, is reversing. In December 2025, the Bank of Japan raised its policy rate to 0.75%, the highest rate since 1995. Markets are pricing in another hike potentially by June 2026. When the BOJ raised rates in December, Bitcoin dropped from 91,000 to 88,500. Within 2 hours, a 2.8% decline that accelerated as over-leveraged positions hit stop losses. The yen carry trade size is estimated to be between $261 billion and $500 billion. When this unwinds, it creates margin calls that don't discriminate. Bitcoin gets sold alongside with everything else. Japanese officials have warned against one-sided and sharp currency moves, threatening intervention. In the 158 to 160 region, we're moving into intervention territory where the BOJ sold around $100 billion in summer of 2024. And China's moves are equally significant. China has sold U.S. treasuries for 9 consecutive months, pushing holdings to the lowest levels since 2008. This represents a decline of more than 47% from the peak of $1.32 trillion in November of 2013. Now, where is all of that capital going? Well, gold. The People's Bank of China announced gold purchases for 14 consecutive months through December of 2025. These aren't retail flows. These are strategic, calculated moves by the world's second largest economy. And these currency moves drain dollar liquidity that previously flowed into crypto, creating cross-border capital flight away from risk assets. So, when will the correlation return? Well, there are 4 key thresholds to watch. First, Fed rate cuts below 3%. Current rates sit at 3.5 to 3.75%. Markets are pricing in 2 cuts in 2026, potentially 1 in June and 1 in October. But the critical level is below 3%. That's when actual liquidity expansion outpaces just dollar weakness. Second, global liquidity expansion resuming after the 2026 refinancing crisis passes. Howell's model suggests liquidity will trough in Q1 to Q2 2026, likely around March. After that, if central banks respond with more aggressive easing, well, we could see liquidity begin expanding again in late Q3 or Q4 2026. Third, Bitcoin breaking above $94,253 resistance. That's the 61.8% Fibonacci retracement level. A decisive break above this level, confirmed by breaking 99,000 to 102,000, would signal technical momentum restoration. The $107,400 level represents a critical midpoint before attempting all-time highs. Fourth, DXY falling below 96.2 on a sustained weekly close. Current levels are around 97.4. But a break below 96 would trigger significant technical selling pressure. Historical seasonality suggests April to May as a potential inflection period for dollar weakness. The pivot point comes when liquidity expansion outpaces refinancing demands. That's when Bitcoin decouples from risk-off sentiment and reclaims its inverse dollar relationship. Most analysts, including Howell, place this potential turn in Q2 to Q3 of 2026. But before you get too excited, remember that these conditions need to align simultaneously. One or two isn't enough. You need all four: Fed cutting below 3%, liquidity expanding, Bitcoin breaking resistance, and the dollar breaking support. So then, what does this all mean? Well, the dollar death doesn't equal Bitcoin moon. Not quite yet. It's about liquidity, not just currency weakness. The 2026 refinancing wall is draining capital, while gold captures safe haven flows. Bitcoin's correlation with the dollar has broken because Bitcoin is being treated as a risk-on asset, not digital gold. Understanding these macro forces is key to surviving this chop. The good news, though, is that the catalysts for reversal are on the horizon. Q2 to Q3 2026 could mark the turning point when actual liquidity expansion resumes. But until then, patience is required. Don't fight the macro tape. Stay patient. Watch those four key indicators: Fed rates, global liquidity, Bitcoin resistance, and DXY support.